I believe that if you get money correct and you understand it, because it's the most powerful tool in navigating our complex society, your life becomes infinitely better and your options broaden dramatically. And like most parents, I wanted that for my daughter. But I made the mistake of pushing it way too hard and way too soon when she was very young. And I managed to turn her off to all things financial. And so as she was getting older, around 2011, I started writing some of this stuff down in a series of letters so the information would be there in case I wasn't when she was ready to hear it. And a friend of mine looked at those. He said, this is pretty interesting stuff. You ought to put it on a blog. And in those days, I'd heard of blogs, but I'd never even seen one. But it struck me as a great way to archive the information. So I created jlcollinsnh.com, which was a blog in 2011, and began writing about this kind of stuff. And then I didn't know that anybody else was writing about anything like this. And at the time, actually, very few were, at least for the financial independence community. But I started paying attention to some of those, like Early Retirement Extreme and Mr. Money Mustache. And to my amazement, the audience for the blog began to grow with strangers, which was never my intention. It was just to archive the information. And then in 2012, I started looking around thinking it'd be kind of fun to speak at some events about this stuff. But there weren't any in those days. So I created the Chautauquas, which we ran until 2022. That was the last one. And those were we take small groups of people to someplace cool in the world and hang out for a week and with cool people in a cool place and talk about cool stuff, all to find how I thought of what was cool. So it was great for me. Some of my best friends are still from those days. And about the same time, I began working on what became The Simple Path to Wealth. It took me 3 years to write it. It was published in 2016. Again, my primary audience was my daughter. I figured at that time, the blog had a lot of information in it. I thought if I put it in a book, I can condense it, organize it better, polish up the writing, and it'd be even more useful. And to my amazement, like the blog had, the book took off, and it's now sold 1 million copies. So earlier this year, I set about revising it for a new, updated version, and here we are today talking.
Well, I want to dig back into the early investing journey of J.L. Collins because I remember hearing you on a podcast, and when you got started, I mean, we take index funds and ETFs and all these things for granted. I think you were investing kind of at the beginning of the index fund. Am I right?
Yeah, well, yeah, you're right. I have been an investor for half a century, 50 years.
Wow.
I cringe saying it. I never thought I'd get to be this old, but I bought the first stock that I ever bought in 1975, which just coincidentally was the year that Jack Bogle created Vanguard. And it was also the year he brought out the first index fund that was available to retail investors, normal human beings like you and me and those listening. I didn't know that at the time. I had no idea. And if I had known it, I know I wouldn't have been wise enough to embrace it. Although, boy, my life would have been easier and even more profitable if I had. The reason I know I wouldn't have been wise enough is when I did finally hear about it in 1985, a decade later, it still took me 10, 15 years to see the wisdom. So for most of my investing career, at least the early decades, I was a stock picker. And by extension, a picker of actively managed mutual funds that were run by stock pickers, with the idea of outperforming the index. But Bogle's great insight was that actually doesn't work. And there's been copious amounts of research since that have confirmed that. And so you wind up paying a lot more money in commission and fees for typically less results. Whereas if you buy a simple, broad-based, low-cost index fund and hang on to it, you pay far less in fees. And as Bogle once said, performance comes and goes, but fees are forever. And you will outperform almost inevitably over time. I'm embarrassed at how long it took me to finally embrace that, but it made a huge difference. Now, in defense, one of the reasons it takes a long time to embrace it, and one of the reasons I think there are a lot of people out there still who are stock pickers and who pick actively managed mutual funds, is it's very enticing. It seems it should be easy to outperform the index, and it's not like those things don't work. I became financially independent doing those things. It's just that they don't work quite as well. They take up a whole lot more of your time and they cost more money. So show me something that costs me less money, takes up almost none of my time, and gets me better results. And will you have the simple path to wealth? I'm there.
That is the simple path to wealth. So 1975, you start investing. 36, I hate doing public math on a podcast. 36 years later is when you start writing these letters to your daughter, which then becomes a simple path to wealth. What did you learn over those 36 years of investing that you started jotting down? Like, what were some of those overarching themes and things that you wanted to convey to your daughter about investing?
Yeah, I'm going to trust you that that's a 36-year period of time with the math.
I think so. I'm like
take,
25 years makes 2,000 plus 11 years. Yeah, 36. Okay.
yeah. I'll take your word for it. So the one thing I did know was that stocks are the single most powerful wealth building tool that we have available, bar none. Right, and I had learned over the years that they always go up. You can look at any chart that shows long-term performance of the market, and it relentlessly goes higher to the right. But it's also very volatile. It's a very rocky and rough road. And so lesson number one that you have to learn is that when the market drops, whether it's a 10% correction, a 20% bear market, or something more severe in the way of a crash, these are perfectly normal parts of the process. It's nothing to panic about. And of course, you'll see nothing but panic in the media when they happen. And so people get scared, but they're really nothing to panic about. It's like hurricanes in Florida. If you live in Florida, you should be prepared to experience a hurricane. And they're scary and potentially they're very dangerous, especially if you go running out in the middle of them in a panic. But if you hunker down, you don't do anything stupid, they go away and the sun comes out and the birds return to singing in the trees. It's the same thing with market crashes. If you just stay the course, don't do anything stupid like selling, the market crash runs its course and the market begins its relentless rise up, making you steadily wealthier and wealthier. But that's critical. The single thing that defines whether the market leaves you bleeding at the side of the road or makes you wealthy over time is what you do when it's dropping. And as Jack Bogle once famously said, don't just do something, stand there. Do nothing. Stay the course. That's the right thing to do. And then, of course, as I already alluded to, it took me a long time to realize how much less expensive, more effective, simpler, and easier index funds were. And once I embraced that, it was sort of like adding some extra rocket fuel to what I'd already been doing. So that's kind of the evolution of my thinking, which came together as first on the blog and then as the simple path to wealth.
So I know we don't like doing public math here. I definitely don't. Sounds like you don't either. But can we just give people some real examples? I know we're preaching to the choir with this audience, but just how bad some of these actively managed mutual funds and other investment options out there are in terms of fees compared to what Vanguard offers, for example.
Yeah. So first of all, the good news is that they have gotten considerably better in terms of fees and commissions. And I attribute that, by the way, to Vanguard creating these very low cost index funds. When they first came out, Jack Bogle was vilified and the whole idea of index funds was vilified. His competitors were running ads calling it communist, calling it un-American, because they recognized correctly what a huge threat to this enormous stream of income that they were bleeding out of us investors, it truly was. Now, of course, all those same investment companies offer these things because they were drag kicking and streaming competitively. So at the same time, the cost of buying and selling stock has plummeted. And the fees that even actively managed funds charge have plummeted. They're still too high, still certainly higher than index funds, especially when you consider that they tend to underperform. But when I first bought stock, I want to say, there was a 5 or 6% commission to buy it, and then another 5 or 6% commission to sell it. Now, because I was buying individual stocks, there was no ongoing fee to hold it, like with the mutual fund. But at the time, there were load mutual funds. Loads just is another word for commissions. So you could easily spend 5 or 6% buying one of those and also selling one of those. Plus, they would charge you 1, 2, sometimes even 3% expense ratio every year. I mean, it's kind of stunning how much they were skimming off the top. And when you think about paying 5 or 6% coming and going, and you think about 3% a year, and you realize that long term the market returns 10, 12%, well, they've taken all the cream and a good bit of the milk into their pockets. So, but yeah, it's gotten considerably better. I think now you can buy and sell stocks pretty easily at no commissions, and fees of even actively funds have come down. But you're still better off in an index fund if for the performance alone.
100%. Just for some numbers, I was typing away a little bit here so I didn't have to embarrass myself getting numbers wrong. But even let's say you have $1 million invested, which isn't that uncommon, people on the FI journey, especially later down the road.
Right.
If you're looking at a 2% like active management fee, that's $20,000 per year you're just paying to this company to do essentially what you could be doing yourself. And with someone like Vanguard, I was looking at the Admiral shares like VTSAX, for example, 0.03%. So you're paying like a fraction, like so much less in fees just by handling it yourself rather than just passing your money off to some money manager somewhere.
Great point, Cody. And another way to think about that is if you think about the 4% guideline for living on your portfolio. So let's use your $1 million example. That means you can pull $40,000 each year and expect your portfolio to last for the long term. Well, that $40,000 is your income. Let's say you're only paying 1% in fees. That's $10,000. That's 10,000 of your 40. That's 25% of your annual income.
That's huge.
Right. So people think 1%, that's not that big a deal, right? It's 1%, what's 1%? Well, it's 10% of your annual income. And of course, if you're paying 2%, that's half of your annual income. And even if you're in one of the less expensive actively managed funds, that's maybe, 0.5%. Well, that's still 5,000 of your $40,000 a year that's going to fees for almost inevitably lower performance.
In terms of portfolio structure, I remember when I first read your book in 2018, I think it was, I got The Simple Path to Wealth. My mom actually gifted it to me. And I remember you had an interesting take on international stocks. I remember that being like one of the things I was like, oh, wow, this is a very different take, very, very different flavor than the other stuff that I've been reading. So one, wondering if your portfolio structure recommendations have changed for folks. And two, if you could talk about the international stock stance that you have.
Yeah. So to answer the question, no, it hasn't changed.
Perfect.
My stance, and it does run counter to, I think, every piece of advice that I've heard from other people, and I just don't see the need for holding international stocks. In my defense, Jack Bogle didn't see the need either. So, I'm in pretty good company when it comes to that. But my reasoning for this is that we've basically got it covered. First of all, the United States accounts for 60% of all stocks traded in the world. So just owning the U.S. market, you own a majority of publicly traded stocks in the world already. And if you own a total stock market index fund like I do, or an S&P 500 fund, which is also works, those are cap weighted, which simply means the larger companies are a bigger part of the portfolio. And those very large U.S. companies are almost entirely, I can't think of an exception to this, international companies. So they are already selling products and generating revenue and frequently have operations in other countries. So you already have international exposure. And if the rest of the world, the world continues to grow, as I expect it will, well, owning those companies, we will continue to benefit from that growth. So I don't see the need to add international. Also, international tends to be more expensive, although those costs have also come down. And finally, the most well regulated markets in the world are in the United States. And we still screw up. We still get an Enron that every now and again people think is doing great, and the next thing you know, it collapses to nothing because they were fooling with the numbers. So it's certainly not a perfect system, but it's the most perfect in an imperfect world. So for those reasons, I don't see a need to own international. Now, when I'm talking to an international audience, which I have developed with the Simple Path to Wealth, I now have a lot of international readers. My advice is different because there is no other country in the world that is as a market large enough where you can invest only in your home country. That's only true for us Americans. So if you live anywhere in Europe, if you're in Australia, if you're in Japan, if you're in China, any place else in the world, those markets are too small. And if I were in those places, I probably wouldn't want to put all my money into another country like the United States. I would probably go into a world fund. And a world fund is just what it sounds like. Vanguard has a great one, but so do all the other major brokerages. A world fund buys stocks from all over the world. And the U.S. typically makes up about 60% of those funds because, as we discussed earlier, it's about 60% of the market. Now, having said all that, a lot of people disagree with me on this, and a lot of people say, okay, I understand what you're saying. Points well taken. I still want to own international. If you feel that way, you won't get any great pushback from me. Then go for it. It's not like you're making some terrible mistake. And if you want to do that, well, first of all, that is my recommendation if you're international. If you want to do that as a U.S. investor, then again, I'd go with a world fund and simple, inexpensive, call it a day.
So let's use me as an example. This is not financial advice. Please don't do exactly as we're about to say, but hoping you could kind of help me think about structuring a portfolio for myself. So I'm about to turn 30 early next year. Let's just use that because a lot of financial advice you'll hear is like, you should have your age in bonds. So like for me, that would be 30% bonds, 70% stocks. I fully reject that. I am almost 100% in equities. Curious how you would think about structuring a portfolio for someone my age and my circumstance.
Yeah, so actually, my thoughts on that are even broader than just looking at you and your circumstance, although we can dig into that a little bit. So I kind of divide it into two stages in life. And these days, people, in the old days, you used to come out of school, you'd get a job, you'd work until you were 60 or 65, and then you'd retire and you'd think about those bonds. Now, a lot of people, like we were talking before we began the conversation, like you, retire much earlier, right? And so I think of it now as the wealth accumulation phase and the wealth preservation stage, which is when you're living on the portfolio. So when you are in the wealth accumulation stage, you have earned income and you are diverting a significant part of that income to buy your freedom, which you do by buying assets. And the assets, again, I recommend are something personally. I own VTSAX, which is Vanguard's Total Stock Market Index Fund. VTI, by the way, which is the ETF version, is fine, same portfolio. Okay. That's all you need. Because when you own that, you own a small piece of 3,600 companies in the U.S., virtually every publicly traded company. And everybody from the factory floor to the CEO is now working to make you richer. You have cash flow to smooth out the volatility of the market. In fact, when you're doing this and you're putting in money every month on a regular basis, when the market plummets, you're picking up shares at a bargain. That is a gift. That's not something to be afraid of. It's something to love, to embrace. Now, let's suppose at the age of 30, Cody says, I'm done working for money. I'm going to live on my portfolio. Well, at that point, whether you're 70 or 30 or any other age, it seems to me, and my daughter, by the way, has just done this. She quit her corporate job last fall. So now she has, I think she's doing 20% in bonds. And those bonds take the place of that cash flow from her earned income to smooth the ride. So now you've got an allocation between stocks and bonds. It could be anywhere from 50-50 to 90-10, depending on your tolerance for volatility. By the way, I would never go below 50% in stocks because you need the growth of stocks for a portfolio to survive for the long term. But now you have an allocation that you choose based on your tolerance for volatility. And when stocks go down, well, then the percentage that is represented in that allocation of stocks also goes down, and the percentage of bonds tends to rise. So now you take some of that bond money, you sell some of those shares, and you buy some of those stock shares at that bargain price. You can also sell some of those bond shares to meet your living expenses while you're living on the portfolio. So that's how I think about it. Now, if we want to talk about you specifically, you'd have to tell me, okay, do you still have earned income? Do you plan to continue that earned income? Is it significant earned income, or are you essentially retired and just making enough money that you don't have to touch the portfolio? All those kinds of variables come in.
Okay, we don't have to dig in. I think the way you answered that question was phenomenal, especially for this audience, because we have people who, quote unquote, retire. They stop working for money anywhere from age 25 to 55. So I just
Right.
love the distinction between this wealth accumulation and wealth preservation, and then shifting the bonds accordingly. Is there like some kind of a formula or way that you think about how much you should be shifting into bonds? Is it just an age thing at that point, like whether you're 30 or 50? Hitting financial independence, quitting active work. Does a 30-year-old have the same bond allocation as a 50-year-old in your stance, or does a 50-year-old have a higher bond allocation because they have less time for the stocks to compound and grow?
Again, it depends on, I think it has less to do with age, and it has much more to do with your tolerance for the volatility.
Okay.
Right. Now, that tolerance, by the way, is both your emotional tolerance for it, but also your practical tolerance for it. So what do I mean by that? Well, let's look at your example. Let's suppose that you've got somebody who's got $1 million invested. If we're using the 4% guideline, that means that they can pull $40,000 a year, adjusted for inflation each year, and have a very reliable percentage of a success rate for lasting long term. Okay. Now, if you need every dime of that $40,000 in order to pay the rent and put food on the table, then you're going to want to have less volatility, more in bonds, because you really can't tolerate much volatility if you're cutting it that close. So if you're in that case, I'm probably going to be saying you probably want to look at 60% stocks, 40% bonds. I'm not personally comfortable getting down to 50-50 because you lose that growth engine. But let's suppose, on the other hand, you were to say to me, you know what? $30,000 pays the rent, puts food on the table, gas in the car. And this other $10,000, that's what I'm using to play with. I travel, I go scuba diving, I climb mountain, whatever it is that you do, things that you could cut back on if the market turned against you and the wind came in your face. Well, at that point, what I'm going to say to you is, you probably want to look, and this describes my daughter, at maybe an 80% stocks and 20% bonds, because you can tolerate more volatility. The more stock you have, the more your portfolio is going to grow, make you even richer, and give you even more assets in which to enjoy your life, right? So growth is, or stocks are your engine of growth. Bonds smooth the ride. More bonds you have, the smoother the ride, but the lower the growth. That's the price you pay. More stocks you have, the more volatile the ride's going to be, but the better the growth. So if you could tolerate that volatility emotionally and practically with your budget, then I say go with as I did with my daughter, go with more stocks. If you're cutting it close, both emotionally and with your budget, then you're going to probably want to load up on bonds a little more.
Makes sense. Sounds like those 2011 letters paid off, and it sounds like your daughter is now following the simple path to wealth, along with millions of other folks. I think on the cover now is over 1 million copies sold. I mean, you've sold in dozens
Yeah,
of languages at this point. Can we dig into your daughter's story? I think I read in the revised edition, she kind of played a more active role, and you kind of talk about her story a little bit more and how she's taken some of these principles and changed her own life. So I guess bring us back to 2011 versus now. Like, what was or wasn't she doing then that now she's changed and just recently quit her job and is living on this 80-20 portfolio you described?
yeah. So first of all, my daughter likes to tease me, and she says, Dad, because I've teased her. I refer to her as the little girl who wouldn't listen, and she in turn says to me, Dad, if I'd listened when I was young, there'd be no blog. There would have been no Chautauquas. There'd be no books, and Cody wouldn't want to talk to you. So, so my wife used to tell me that Jessica was absorbing more than she let on. And I used to say, I know that's true because as far as she lets on, she's not absorbing anything. So it has to be greater than zero, but not by much. Well, it turns out my wife was right. And when I started looking at what to do next with the book, kind of with my estate planning in mind, Jessica and I were talking, and I said, whatever I decide to do here is going to affect me for about a decade. It's going to affect you for half a century or more. So you might want to have a role in making these decisions. And kind of to my amazement, as we talked about it, I knew she was on the simple path because I could see the results. But I thought she was on the simple path in the way I designed it, which is to say, for smart people who know it's important, but don't really want to think about it very much. And one of the beauties of the simple path to wealth is if you understand a couple of key principles, like we've discussed, you understand where to invest, like we've discussed, you set it up, put it on autopilot, you can then forget about it and go about building bridges or curing diseases or teaching school or whatever it is that turns you on. And that's what I thought she was doing. And I think in the beginning she was, but turns out she had developed a much deeper understanding and appreciation for the work. So one of the most gratifying things about doing this new edition in the book is she played a very active role in the re-editing of it and designing what it was going to look like and the reorganization of it and what new material would go into it. And that was enormous fun for me because my daughter and I have always got along well, but this was a meaningful project for both of us that we got to work on together. And it really drove home to me in a way that was enormously personally gratifying, just how well she understood this stuff. And I had candidly no idea.
So one of the things I think that's changed in the revised edition, correct me if I'm wrong, is that now there's just so much crap, quite frankly, on social media. Everything is about the shock value. I've had people tell me index funds are boring. I don't want to earn 10%. Like my buddy Johnny, he made 5,000% on this meme coin. He put in $1,000 and he just made 100 grand. Like there's all these stories that you hear. And unfortunately, these are the stories you hear on the news. It's not the guy who maxed out his IRA every year and it grew at 10%. And then in 40 years, he's rich. It's the kid who overnight got rich on some NFT or some meme coin. How do you get those Gen Zers not distracted and focused on the actual vehicles that can build the wealth? And how did you think about framing that in the book?
Yeah, so to be perfectly honest, I don't talk about that a lot in the book. There is one of the features in the book is an FAQ section, which is new.
Yes.
And the FAQ section is where I address those kinds of things because, and I talk specifically about cryptocurrencies in the FAQ section. I'll be happy to tell you what my take is on those. But, I don't think I or anybody else is going to take some Gen Z person or some baby boomer person who is enamored with the idea of getting rich with meme coins or meme stocks or whatever it is, I mean, you're not going to dissuade that kind of mindset until they learn the hard way. You're absolutely right. You're not, you don't see me being interviewed on CNBC because that's not what they want. They want this drama. They want this excitement. That's what the news is all about. It's not about informing you and making your life better. It's about exciting you, scaring you, keeping eyeballs fixed on what they're talking about. And that's social media, that's tradition, that's everywhere, right? So you have to be wise enough to recognize that. The second thing you have to be wise enough to recognize is, yeah, these stories might be true. There are people, I'm sure, who, let's just take Bitcoin as an example, who bought Bitcoin a decade ago or 15 years ago, hung on to it through thick and thin, and it made them enormously wealthy, but very few. Most of them probably sold out once it doubled or tripled, but it does happen. And I think you need to recognize that, just like some people win the lottery, right? That does happen. Doesn't mean buying lottery tickets is a great investment strategy. This is the principle that casinos work on, right? It's amazing to me. I used to, in my business career, go to Vegas on a regular basis because conventions were there all the time. And it would amaze me that my colleagues and customers, almost all of them would talk about how when they went to Vegas, they all made money. And I would look up at these billion-dollar casinos and say, yeah, okay. I think what's going on there is a unique part of human psychology. We remember the time we won at the tables and conveniently forget all the times we lost. And the casinos recognize this, and the casinos want people winning, right? Because that's the excitement that keeps people betting. And they also know that if you hit it on the slot machine and you win a bunch of money, you are almost inevitably over time going to feed that money back into the slot machines and give it back and lose more. I have a friend who a couple of years ago, I want to say 3, maybe 4 years ago, won over $300,000 on the Kentucky Derby. I mean, stunningly good luck. The problem is, if you confuse that good luck with skill, which is what most people wind up doing because we have egos, then you progressively give it back. So every Kentucky Derby since, I email them and say, how much you make this year? I don't want to talk about it. How much did you bet? How much did you lose? I don't want to talk about it. One of the problems, one of the key characteristics of quick wealth, even if you're fortunate enough to experience it, it's maybe not so fortunate. Almost inevitably, most people give it back. If you look at lottery winners, the evidence is clear. A huge percentage of lottery winners wind up bankrupt. They don't know how to manage the money when it comes to them quickly. They're not prepared to hang on to it, and it just dissipates. Wise people once said, money goes where it's treated well, and that's where it stays. And if it's not treated well, it flees. And if you treat it, if you gamble, even if you win, you're going to give it back because it's going to flee from you. It's not treating it well. If you invest steadily for the long term, it's not exciting, but I don't expect my money to entertain me. I only expect my money to work for me. I want it to make me more money. If I want to be entertained, I'll take a small amount of money and go to Vegas and play poker. And call it a day, not expecting necessarily to win, but just to have fun.
I love that. You don't expect your money to entertain you. One
No.
story I was hoping you could share that I read, because in the little Spark Notes version you sent over, you mentioned a story about Tom. So I went to the book and found that story, and I thought that would be an interesting case study to share with the audience.
Boy, I'm so glad that you feel that way, because that is probably my favorite addition to the book, personally.
Wow.
There's,
Okay.
the basic philosophy is unchanged, right? So anybody who's listening to this who has read The Simple Path to Wealth and is implementing it, be assured that you don't need to buy the new book to follow The Simple Path to Wealth. There's some cool new stuff that you might find interesting, but you don't need it. And Tom's story is, in my mind, the coolest. Since I started writing, even going back to 2011 in the blog, so what is that, almost 15 years now, 14, 15 years. One of the things that is most remarkable to me is how much fear people have, even successful people on this path, right? So I've met countless people who have basically followed the simple path to wealth. It's worked for them. It's made them millionaires. They are sitting on, I don't know, $2, $3, $5 million. They've kept their spending well under 4%, and they're worried about losing it. They're just worried about losing it and I mean, I can just understand that would be a very bad day, but you are probably not going to lose it. If you have had the discipline to do this and get to that point, what would have to happen to the society in general, to the culture overall, for you to lose that money would be so devastating that money will be the least of any of our worries, right? So it just kind of baffles me that there is this fear in so many people. The story of Tom, I was telling the story on another podcast, and the question I got is Tom a real person? And the answer to that question, I'll start with yes, Tom's a real person. He's used to be a client of mine back in the 90s, which is how we became friends. He was in the advertising business. He was an ad agency executive. But at the age, and he was pretty successful, but Tom went through a couple of marriages, a couple of divorces, a number of kids, and the divorces are expensive. And at the age of 62, he lost his job. Nobody wants a 62-year-old advertising executive. So he was basically unemployable in his career field. And he was broke. He lost his house to foreclosure and he went bankrupt. Tom lost everything. The only thing he was able to keep in the bankruptcy was he had a collection of antique guns, and he made an appeal to the judge, and the judge said, okay, you can keep those guns. They weren't worth a lot of money, but sentimentally, he let him keep. That was it. So at the age of 62, Tom found himself with a small pension from one of the companies he'd worked for, very small. And he took Social Security because he needed the money. Taking it at 62 is not optimal because your check is reduced, but if you need to pay the rent, put food on the table, you do what you need to do. And then he got a job. He lives in the Detroit area. Then he got a job at the farm, and the Henry Ford Museum complex has a farm that is in the style of the 1800s, where people in period costume, actually, it's a working farm, and these people actually do the farm work, but they also engage with the tourists, talking about how it was done back in the day and all that. Well, that's what Tom does now. So he's outside. He's getting sunshine and exercise and engaging with people, which he's very good at. He loves it. That supplements that little pension and Social Security. He's recovered. Tom is probably the least successful, financially least successful person I know, personally. He's also probably the single happiest person I know, because Tom just has a great attitude. He's 3 years into a new relationship with a woman. Tom's the kind of guy you want to be around. Tom has deep friendships from when he was a kid in Michigan. I value my friendship with him. He's the kind of person you want to be friends with. He's the kind of person that men want to be friends with and women want to be partners with. And I think that's one of the things that makes him so effective doing this tourist farm work kind of thing. But again, so money isn't everything is the point of Tom's story. So if you follow the simple path, which obviously I recommend because money can make life easier and better, give you more options. Once you get there, stop worrying. Stop worrying. Even if the worst thing happens, if you have the right attitude like Tom, it's still going to be a good life.
I'm actually really glad we went in this direction, that money isn't everything. Money is a tool, because I think many people in the FI community, myself included, if we follow your teachings and other teachings, people talk about compound interest and index fund investing. I mean, I started investing when I was 18. chances are when I'm in my 40s, 50s, 60s, I'm going to have multiple millions more than I know what to do with. And I know there's probably a lot of other people who started very early who are probably going to follow a similar path. How do we start to learn how to spend money better? Because I think so often in this community, it's about how much can you hoard? Like, oh, I got this net worth milestone and this and that. And it just becomes all about the numbers. But at some point, you got to kind of step back and realize like, hey, money's a tool. Money is something that I can use to better my life. It sounds like Tom has that figured out, even though he maybe didn't get the money piece right. But how do we, the FI community especially, figure out how to spend money in a way that benefits us?
I agree. First of all, I agree with everything you said. I think one of the most overlooked things for people beginning on this, you started, by the way, congratulations. You started
Thank
at
you.
18. Because
of people awesome. Like you, JL.
Well, yeah, but you've got to do it. I mean, I talk to lots of audiences, and most people are never going to do that, right? They'd rather buy trinkets and trash with their money. You know, we in this community following this path are unicorns who say, you know what, the most valuable thing to me is my freedom. So kudos for you for being on the path. Time is your friend, and you're absolutely right. You're going to wind up with more money than you can possibly imagine, right? As you get into your 40s, 50s, and 60s. I'll give you a great example of that. I have some friends, this goes back quite a while now, but they accumulated, and they're on this path, right? But one of their ambitions was to live in rural Vermont, right? Into homestead, basically. And I was living in New Hampshire at the time. And if anybody is familiar with those two states, they're indistinguishable in terms of the topography. They're both wonderful places to live. Key difference, New Hampshire has very low taxes. Vermont has very high taxes. These people, for whatever reason, were enamored with Vermont, and they bought a place in Vermont. And they have a couple of kids. They're raising their family there. And I was talking to them one time, and I said, you know, why didn't you look for a place in New Hampshire where the taxes are lower? And they said, well, you know, taxes, we don't really pay much in taxes because we don't have that big an income. And so it's not really a factor. I said, well, that's now. But the trajectory you're on, just as you described, you know, by the time you're in your 50s or 60s, you're going to have enormous wealth that's going to be heavily taxed. And by the way, Vermont also has an inheritance tax. So when you die, the state of Vermont is going to confiscate the wealth a big portion of the wealth you built and take it away from your children. And you could have had exactly the same topography in life, you know, 50 miles away in a state that doesn't do that. But people have trouble seeing how powerful compounding is when you go over time. So I was having a conversation yesterday, actually, on another podcast with Jillian Johnsrud, who's a friend of mine. Jillian just wrote a book that she let me read in advance called
Retire Often, right?
Retire Often. Yeah. And I love this book because that's how I went through my career, right? I loved working. I had no interest in retiring early. I didn't even know the concept, but I didn't want to have to work all the time. So I wanted to have what I called FU money so I could step away periodically. So I would do that. And one of the questions that came up is, well, gee, if you're on the simple path to wealth, and I didn't think of it in those terms, but that's what I was doing, and you stop working for 6 months, or the longest time I was away was 5 years, doesn't that kind of slow you down? Goes back to what we were talking about before, building your wealth, living on your wealth, right? They said, yeah, but it makes for a better life. And so, sure, you want to get to FI, and the bigger your savings rate, the faster you will get there. But you also want to have a great life along the way. And if stepping away from work, you know, I'd rather do that and work until I'm 60, which I did, because again, I enjoyed work. I would not have wanted to grind out 40 years of unrelenting labor with 2 weeks a year vacation. But I took these mini retirements. I didn't have to. But I also don't think I would have wanted to grind out 15 years and then get to this magic FI number and then try to figure out what to do with the rest of my life, at that point. So, yeah, I mean, you can do whatever you want. The bigger your savings rate, the sooner you'll get there. And if you take sabbaticals like I did, that'll delay it. But your call. I mean, my friend, the mad scientist, absolutely grounded out. He had a huge savings rate. I think he was like 70, 80%. He got there in very short order. And then he started living on the portfolio and suddenly realized, I could have saved less, lived more, taken my time, and had a better life. To be clear, he's got a great life now. If you get to financial independence, I mean, he's got a great life. So in a way, it paid off. But it's not essential. There's flexibility in how you approach it.
Now, this is going to be a question I think I already know the answer to, because at the beginning of the podcast, you said you've been investing for half a century. But this time's different, JL. We have tariffs, political unrest, inflation is higher than it's been in previous years. Is this time different? Because I've had so many people tell me that the reason they're sitting on the sidelines is they want things to quote unquote simmer down. What do you say to that?
Well, first of all, things never simmer down. There, the market is, as one wag once said, the market climbs a wall of worry. So, there's never going to be a perfect ideal time to invest in the market. And when times get really good, by the time you recognize that, the market's already gone up. So you're just dooming yourself to buying high. So right now, as we're recording this, a month ago or 6 weeks ago or whatever it was, the market was down almost 20%, largely around the fears of this tariff. Now the market has actually posted a gain for the year, a small one. I mean, I certainly would not have predicted that at the time. I have no idea whether the market's going to continue to rise and it's going to be a good year, or if it's going to turn around and we're going to have a bear or something. I mean, I don't know. Nobody really knows. So first of all, we don't know at any given point what the market's going to do. But and we're sort of living through this moment in time. So let's acknowledge that we don't know what this market's going to do. But you know what we do know? We do know what past markets have done. So let's look at COVID as an example. So then, just like now, my social media and blog are lighting up with people saying, JL, certainly this time is different. I mean, I've gotten this with the tariffs, certainly this time is different. With COVID, JL, I understand everything you've said. And I understand in most cases that's going to be true in the market, but this is different. People are dying. Entire economies, entire countries have shut down their economies indefinitely. This time is truly different. My response to that then, and also would be the same now, is yes and no. Yes, in that this time is different because the trigger for a market crash is always different. And it's always terrifying, just like COVID. COVID was uniquely tragic in that people were dying. We hadn't had a pandemic for 100 years, so it was shocking. But that's the kind of thing it takes to make the market crash. So it's always going to be the same. And I said, I have no idea how deep this is going to go, how long it's going to last. But what I absolutely know is it will pass. The market will get over its panic and it will recover and go on to newer heights. And I would say the same thing now. I never would have predicted, if we were talking a month ago, that the market would already be back to being higher year to date than it was then. I mean, I certainly didn't see that coming. And again, I have no idea where it's going to go. Now, the question obviously is, well, what if you're wrong? Let's take COVID as a good example. Let's suppose that COVID turned out to be the Black Death, right? The Black Death in the Middle Ages killed 60% of Europe's population. 60%. I mean, COVID killed, 0.5% of Americans. Still a big number because there are 330 million Americans, so 0.5% is a very big number. But still, it's not derailing civilization. If we lost 200 million Americans and an equivalent around the world, then yes, now the simple path to wealth isn't going to work anymore. But that's one of those events where that's going to be the least of our worries because that's a civilization ending event. I am tragically old enough to have lived through the Cuban Missile Crisis in the early 60s. I was a 13-year-old, so I was very young, but nevertheless old enough to remember it. And one of the stories to come out of that was two investors talking, and because it really looked like we were going to get into a major nuclear conflict with the Soviet Union. And that would have been a civilization ending event with nuclear winter and all that kind of thing. Closest we've ever come to nuclear war, as far as we know. And the one investor was saying, this is looking really scary. I mean, I'm going to sell all my stocks. And of course, the market was down because it was scary times, just like COVID. And the other investor said, well, I'm buying. I'm buying as much as I can because one of two things is going to happen. Either the missiles are going to start flying and then nothing matters, or they're not, and the market's going to rebound and I'm going to make a bunch of money. So that's, I think, the way you need to think about it.
Was there any point throughout your investment journey? I'm trying to rack my brain for all the crashes since 75. I mean, in the 80s, there was like the savings and loan crisis. Then we had the tech stock boom in like 2000, 2001. There was like 2008, the Great Recession. We had COVID. We had some other ones along the way. Were there any of those where you strayed off the simple path to wealth and thought things were going to be different, and you had maybe a fleeting moment where you wanted to pull money out of the market?
Yeah. So first of all, the answer to that question is yes, and I'll happy to tell you that story. But let me address sort of the broader thing that you raised first. So, market. I just put up a post on the blog, my most recent post, where I talk about the single thing that determines whether the market leaves you bleeding at the side of the road or makes you wealthy is what you do when it drops. And I talk about 10% corrections happen every year or two. Bear markets happen about every 5 years. Major crashes are much rarer. And in my investing life, there have been three. Actually, one was just before, in 1974, before I started investing in 1975. So there was a major crash in 74. There was the tech crash that you alluded to, which took the market down, I want to say 48, 49%. That was in 2000, 2001, 2002. And then there was a debacle in 08, 09, which took the market down, I want to say 56%. And so those two came pretty close together. And in that decade, the first decade of this century, the market went nowhere for a decade. I mean, it lost, I think, 0.63% a year. I mean, it was, and so a lot of people say, gee, I wish I'd known that. I would have stayed out. I look at it and say, if you were on the simple path to wealth and you had been staying the course and accumulating shares all that time, well, of course, beginning at the end of beginning in when did the market bottom? It bottomed in, I want to say, March or April of 09. From that point on until now, we've had a major bull market. You would have spent a decade acquiring shares at a bargain price that would have really served you well the following 15 years. So with that backdrop of understanding, to answer the question you really asked is, did I ever fuck up? The answer is yes. And the time was Black Monday, 1987. Black Monday was the single biggest daily drop in market history. Nothing had been worse before or since. Nothing even in the Depression. The market in one day dropped 22 or 23%. Now, this was before computers. This was, before cell phones. This is when I was still using a stockbroker. I was still buying individual stocks, and I'd had a long day at work. And at the end of the day, and I was kind of friends with my broker, my stockbroker. I thought I'll call Wayne and just kind of chat a little bit at the end of the day. So I did. I call Wayne. He answers the phone. I say, "Hey, man, how's it going?" And there's this long pause. And he said, "You're kidding, right?" And I could tell from the tone of his voice. And I said, no, no. Why? He said, man, this has been the worst day ever in the market, the worst day of my life. I've had clients calling and screaming at me all day, and the panic is everywhere. And that's when I learned about Black Monday. Now, to be clear, I knew what I should be doing. I mean, at that point, I was sophisticated enough to know what the right thing to do was, which is nothing, to stay the course. And for the next 2 or 3 months, I did. Black Monday was in September, if I recall, but after Black Monday, the market kept grinding steadily lower and lower. And finally, in December, I made the classic mistake that I now rail against. I gave up. I threw in the towel, I sold, and I went to cash. If that was not the absolute bottom of that market, it was close enough not to matter. And then I sat on the sidelines, watched the market recover, watch it come all the way back, and then post gains beyond where the high, but just before it had crashed. So by the time I got back in, I'd locked in all my losses, and I had to pay a premium to get back in the game. That was a huge lesson, a very expensive education. That's why, the tech crash didn't faze me. That's why the 09, 08 didn't faze me. That's why COVID doesn't faze me. That's why now doesn't faze me. I am hoping that people listening to us, and my daughter for that matter, don't have to make a major kind of mistake like that for it to sink in. And that's one of the reasons I talk about this stuff and write about it. And I'm not sure if that's true. Maybe to really, I understood it intellectually, but I didn't know it deep in my gut. Maybe deep in your gut, to learn it there, you have to mess up and endure the pain of the mistake. Obviously, I did. I'm hoping that other people don't, that they're smarter than I am and can just learn from my mistake. But yeah, that's my that's my embarrassing story.
Well, thank you for paving the path for folks like me, so I can, knock on wood, hopefully not make those same mistakes, ride the course. Right. I know there's people who started investing who are around my age who dumped it all during COVID because, like you said, they thought it would be different, and then they're kicking themselves when the market recovers in a month or two. It's
if I can address that real quick.
Yeah.
In today. So back about, again, 4-6 weeks ago, when all this tariff stuff had the market really rattled and it was down, I think got down 19% or what have you. There was a comment that appeared on my blog that from a woman who said, I just sold everything. I went to cash, and I learned that I just can't stomach this. I can't, I can't sleep at night. And I've learned that the stock market is not for me. And that's a perfectly legitimate point of view, by the way, because for the stock market to make you wealthy, you have to endure this stuff. This is the price you have to pay. And if you are unwilling or unable to pay it, there's nothing wrong. I mean, thyself, as the philosophers say. There's nothing wrong with that. The tragedy for her was that she had to go through this to learn that about herself. Now, the market today has given us a gift. It's recovered from that 20%. And so I would say to anybody listening, if that was gut-wrenching for you and you stayed the course and really made you scared and uncomfortable, you have just been given an opportunity without taking a huge loss to readjust your portfolio in a way that makes you much more comfortable. And there is an investment. I have a guest post on the blog called WARM, which is an acronym. I forget exactly what it stands for, but it's spelled like the word warm. So you can go to the search function of the blog and find it. It's a guest post written by a friend of mine who does not invest in stocks. And it's an approach that's not going to give you the kind of growth that stocks do. But if you don't want to deal with the volatility of the stock market, which is a perfectly legitimate point of view to have, this is an approach. And this is what this woman who commented said actually, she referenced that post. She said, I'm going to embrace this instead. It's too bad she didn't know that about herself before. It's too bad she didn't wait for, 4 or 6 weeks for this opportunity. But of course, nobody knew it was coming. But if that describes anybody listening, you've been given an opportunity, and now is the time to assess whether or not you really want to are willing and able to deal with the volatility that will always be in the market. There will always be bear markets and crashes. You can count on them. They're a natural part of the process.
I just found that post on your website. It was Sleeping Soundly Through a Market Crash, the Wasting Asset Retirement Model. So that's the one. We'll make sure we link that up in the show notes, along with, you mentioned your most recent blog post and just your blog in general. I know we're actually over our time here together, JL. As we bring this thing to a close, where do you want to point folks? I know you have the revised edition of The Simple Path to Wealth. You have your blog, JL Collins NH. Is there anywhere else, or are those the best two places to send people?
So first of all, I don't mind that we're over it all. I've really enjoyed the conversation and the great questions. Yeah, you just named them. I mean, that's how to reach out to me. I'm not sure when you're going to release this, but May 20th is when the book is out. Before May 20th, you can pre-order it on Amazon or through Barnes & Noble as of May 20th. And this is one of the I self-published the original edition. This is through a publisher, and one of the advantages of that is that, as they say, it will be available wherever books are sold come May 20th. So there you go.
Perfect. Well, when this episode is out, it's going to be dropping on the day that the book releases. We lined it up magically with our editor and team, so don't worry about it, JL. We got your back. So when you guys are listening to this, the book will be out, available for purchase. Bunch of revised charts and new additions and things in the book, but the principles are the same. So I know you mentioned if you read the first one, the second one has more goodies in it, but it's more of the same.
And
it's not a completely revamped investment strategy. The same, index and hold is true and true.
Absolutely.
Well, just want to say thank you for coming on. This has been such a long time coming. I've been such a fan since 2018 when I first read your book, heard you on many a podcast. You're part of the reason why guys like me and Justin can retire in our 20s and 30s. And it's just awesome that you've been affecting millions with this message. And I'm sure there's going to be millions more to come.
Thank you so much. I appreciate the opportunity of being here. It was a lot of fun, great questions, and kudos for starting so young. I mean, what a huge advantage. I wish that I'd had a book like this back in 75 and I was 25 back then, so I wasn't even as young as you. But I mean, I think you retired by the time I was just beginning to invest.
Well, thank you for writing the books that paved the path for me, because without this, it wouldn't be possible. I'd just be flailing, investing in individual stocks, trying to figure it out, selling during market crashes. Who knows what I'd be doing? But because of guys like you, I was able to make it happen.
You'd have bought Bitcoin and you'd be a billionaire.
Oh, man.